Okay, hi everyone. Welcome to today's session on Introduction to Volume Analysis. Right, so I'll just give it about 1 to 2 more minutes for more people to join us and we will get the session started. At the same time, if you guys have any questions, feel free to put them under the chat box or the Q&A box. So I have both of this open, right? So if you guys have any questions, feel free to put your questions there. So we'll just give it about 1 more minute before we begin. Right, so before we get the session started, let me just bring up this as well. So for those of you guys who want to access the previous recordings, you can find them on Vantage YouTube site. So let me just bring this up. Okay, just go to vantagemarkets.com. So you can just go to vantagemarkets.com/webinars. So over here, you can see the different schedule as well as the topics that are being covered. You can also review and take a look at the previous recordings, right? So we do have webinars on a daily basis on Wednesdays, Thursdays. Wednesdays and Fridays are our live trading session. And on Thursdays, these will be our educational series. So if you do want to have a copy of the recording, right, you can head to Vantage YouTube page and you should be able to see all the webinars that were done previously. Okay, so let's get the session started. Right, so those of you guys who just joined us, a very warm welcome. So for today, we are covering on volume analysis. So we will be going through the basics of volume analysis and we will hop on to the trading view chart as well to see how we can apply them. So just a quick introduction of myself. I'm Lee Sing. I provide FX advisory to institutional clients. I'm also part of the team that's recognized by the Technical Analyst Awards as finalists for the best FX research. If you guys are watching the recording recording on YouTube, right, feel free to reach out to me on LinkedIn. If not, if you're here with us live, right, please put your questions under the questions chat, either under the chat box or the Q&A box. So just a quick disclaimer before we get the session started. The information presented here is not to be treated as investment advice and it's for educational purposes only. So this is the agenda that we will be covering for today. We will first hop on to cover the introduction and the basics of volume analysis. We will also touch a bit on the relationship between volume and price, as well as the advantages and disadvantages to consider when we're doing volume analysis. And then finally, I'll be covering two commonly used volume indicators. So one thing about the FX market, it's that volume might not be provided by every brokerage, right? So there is no centralized exchange. So in this case, the volume, if there's any volume, it will be based on that specific brokerage rather than the overall volume, right? So given that we don't have a centralized exchange that can aggregate all the volume. So let's cover the basics of volume analysis, right? So in general, volume, it's a measure of the units. So this can be expressed in terms of the number of shares if you're trading equities, right? Contracts or lots traded. So on a standard account, right, in FX, right, the minimum lot would be 0.01. So volume analysis itself is a technique to analyze the volume of trading activity in the financial market. The idea behind this is to use volume as a confirmation, either to identify trends. So this can be in terms of confirmation of a breakup. So imagine where we have a case here. So imagine a case here where prices are testing the support level. Okay, so imagine this case where prices are testing this resistance, sorry, not support, right? Resistance level here, where it encountered resistance and we're seeing prices move lower. Every time it comes into a resistance zone, what happens in this case is that when price breaks above this level, right? So this can be a breakout. So one way would be to wait for a break and close above this zone before playing a pullback. But along with this breakout, right, we can also use volume as confirmation. So on this breakout, what we want to see ideally would be strong buying pressure. This can be in the form of rising volume to confirm that there is indeed a break above the resistance area. So this is one way, right? So taking a look at consolidation periods and identifying a break of the range, and we can use volume and spikes in volume to confirm that there is indeed movement rather than just a strong spike before going in the opposite direction. So the other one would be to predict price movement, right? So in general, when there is a downtrend, for example, markets forming a lower lows and lower highs coming into a region where prices start consolidating, you can see that in this case, there would be a decline in volume. So usually at the extremes, right, volume would decline before we see a breakout, and this breakout can be accompanied with higher volume. Okay, so if you guys have any questions, right, there's no need to raise your hands, right? You can just put them under the chat box or the Q&A box. Okay, so yeah, if you guys have any questions, feel free to put them there. So volume in general can provide us with valuable insights in strength or the weakness of a particular price move. It can also be useful in helping us to validate trend signals. So as mentioned, if prices are in a strong uptrend, when price approach a consolidation area or a demand zone, right, we want to see that on the smaller time frame, if there is a break of the last structure, this is usually confirmed with higher volume. So we'll take a look at a few examples of this later on. So this can also be used to identify potential reversals. So this would be, again, right, taking a look at the range and seeing how price reacts when it comes near a support or resistance area. So in general, right, one way you can interpret volume, it's that high volume would indicate strong market activity. You have a lot of buyers or sellers at a specific price zone, and that's pushing prices higher, for example, and it indicates interest in a particular currency pair in this case, right? It works for stock markets as well. Whereas low volume would indicate a lack of interest, a lack of liquidity. So when there is a breakout accompanied with extremely low volume, right, this might be a case where it's not sustainable. So a break in this range itself, the movement might not be as sustainable. So these are just things to take note of for volume. Right, so let's take a look at the next slide. So let me clear the drawings. So the next thing that we want to look at would be the relationship between volume and price. So volume and price, volume itself can be a confirmation of price trends, but as always, you don't want to trade solely based on volume. The concept behind supply-demand areas, right, and using smaller time frame as confirmation, so what we covered yesterday, those are important insights as well, right, in helping us to determine whether there is indeed a change in trend. So high volume during a price trend itself indicates strong buying and selling pressure, right? Whereas low volume would indicate a lack of conviction. So let's take a look at dollar yen as an example, right? So there are a few ways you can take a look at volume. So for this example, right, I will be taking a look at the OBV, so on balance volume. So in this case, right, so maybe before we hop onto the dollar yen chart, let's go through the basics of this first and also understand a bit more on balance volume as well as the VWAP before we hop onto the charts. So we can also take a look at volume in terms of divergence, right? So what this means is that when there is a divergence between volume and price, so if we are in a downtrend and prices are forming lower lows and lower highs, you can see over here, right? So when there is a divergence, it just means that while price continue forming lower low, right, you can see that there is a pickup in volume. So instead of forming new lows, we can see higher lows that are being formed in volume. So this itself would be a divergence. So a bullish divergence, right, would occur at the bottom of the market. So when we see a reversal in the volume and a pickup in volume, right, this could indicate that price has bottomed and we could be seeing a reversal here. Of course, along with that, right, we want to combine them with, say, market structure or even other indicators like a move above, let's say, the 50 moving average, right? So this would be signals that price or trend itself could be changing. So we talk about divergence between volume and price, and this signals a potential reversal. Of course, not all divergence work, right? Some divergence itself would give false signals, but the idea behind this is looking at how price can form new highs. So on declining volume, so take a look at this example where you can see that if prices are in a strong uptrend, you can see strong buyers or strong buying pressure pushing prices higher. But when this is accompanied with a declining volume, it could indicate a lack of interest, right? Or lesser number of buyers entering the market. And in this case, right, this move might not be sustainable. It could indicate a potential reversal. So when there is declining volume, even when prices are forming new highs, this could indicate a lack of buying interest, and it could form a potential top in the trend. So this is how volume can be useful in identifying reversals, right? We can also look for spikes in volume at key price levels. So at key support resistance levels, you want to see ideally an increase in volume, right? So it indicates higher interest. So there are a few things, right? When we talk about volume, of course, there are advantages and disadvantages that goes along with them. So in general, volume helps us to derive valuable insights in market activities as well as sentiment. So if there is a breakout or a break above a key zone, and this is accompanied with higher volume, generally we can use it as a confirmation of the move in that direction, right? So this can confirm or invalidate trend signals. If there is a lack of volume to support this move, right? We can see that usually there's a lack of interest. In this case, the move up, especially on the breakout of a range, this move itself might not be sustainable. So ideally, we want to see it being accompanied with higher volume. We can also use it to identify potential reversals. For this would be useful when we take a look at volume divergence. So again, when prices form a bullish move up and you see higher lows and highs being formed, if there is a decline in volume, you can see in this case, right, this is a bearish divergence. How so? You can see that prices are forming new higher highs, whereas volume it's declining. So in this case, right, it indicates a lack of interest. You can have less buyers coming into the market, and in this case, this buying pressure, it's not sustainable. So this could indicate a market top. But the two disadvantages of volume analysis in general is that there is limited data. So volume data is not always available for markets or securities. So in the FX space, especially, right, it's not a centralized, there's no centralized exchange. So in this case, not all brokers would provide this volume. So if you take a look at the charts on TradingView, I believe on uh, on most of these brokers, right, you don't get to see volume. So there's some brokers that do provide them. So you do have to toggle around with the names and see which are the ones that do provide volume. Volume itself should not be traded solely based on volume, right? Take a look at market structure, take a look at supply demand zones, because just trading based on volume can be misleading. So as with other indicators itself, or even looking at just chart patterns, ideally you want to combine them with either support resistance areas or even taking a look at the order flow on the higher time frame instead of trading purely on volume. So volume can be influenced by a variety of factors, right? It might not be purely technical. It could be influenced by fundamental factors as well, right? So if there are key news releases, we could see sudden spikes in volume, right? If you are in the equities market, right, could be earning results, right? So if there are any earning releases, right, that might impact volume as well. So this might not accurately reflect supply and demand dynamics, right? So in this case, we're looking purely at technical levels, but if you take a look at the fundamental factors, so for example, maybe even Fed interest rate decisions, right? All this would impact the movement as well. So just a few things to note on volume, right? So let's take a look at the commonly used volume indicators. Right, so if you guys have any questions so far, right, please feel free to put them under the questions chat. And I'll be covering two commonly used volume indicators before we hop onto the chart and see how we can apply them. So the first one, it's the on balance volume, right? So this is also termed the OBV. So on balance volume, it's a momentum indicator. So essentially, it tracks the relationship between volume and price. So that's one thing about volume that's useful, right? So in general, when you take a look at volume, you want to ensure that when price it's moving higher, it's accompanied with an increase in volume, which shows that there is strong and sustained momentum. So on balance volume itself is calculated by adding the volume on the up days. So essentially when price close higher, it is added to the on balance volume. And when prices close lower, right, this is subtracted from the volume. So when you have a rising OBV, what this indicates, it's a strong buying pressure and there is a potential uptrend. Of course, you don't want to trade solely based on OBV, but that is the idea, right? And when you have a falling OBV, it indicates selling pressure and a potential downtrend. So let's take a look at what we have on the charts. Right, so this is an example, right? So an example that we have on TradingView. Let me just clear all these drawings. So in general, you can see here, if you take a look at this chart, so I'm currently on TradingView right now, just load any chart, right? So let's say on this area, so you do have to toggle between the different providers to see which are the ones that provide volume. So for example, in this case, right, you can see that brokers who are data providers that do not provide volume, right, they don't have basically the volume indicator, so you're not able to read the volume indicators. So in this case, right, I'll just use one that provides the volume. Right, so this is an example on Aussie dollar. So the idea behind this is just seeing how we can apply OBV on Aussie dollar. Right, so you can see that during high periods, or rather during periods of strong movement. So you can see before that, right? Let me just go on to the 4 hours time frame so that we are able to see what is the general market structure. So for those of you guys who are not familiar with market structure, we do have a recording of it in yesterday's session, right? So do take a look at that recording. So in general, when we are in an uptrend, what we want to identify its market structure first, right? So you can see here, right, prices are forming your higher lows and higher highs coming into this region. You can see higher lows and higher highs being formed before a break of the last low. So on the 4 hours, we know that any pullback within this zone itself could see a more bearish move downwards. So this is the last leg or the range of the move, right? So essentially, the idea is that if there is a change in structure, in this case, there's a change in trend, we saw a break below the last low. So what happens is that when price comes into a resistance zone on the higher time frame, take a look at this example. So if price comes into a resistance zone on the higher time frame, this can be marked out based on supply demand areas, right? So if price mitigates into a supply zone on the higher time frame, we could see a reversal. And if this is accompanied with a decline in volume, or a divergence in volume, then it confirms that reversal. So in this case, you can see that volume is still increasing on the 4 hours time frame here, right? So volume it's forming subsequent higher highs. In this example, you can see that this is the last range that we're trading within, and this is the retracement. Currently, in terms of the supply region, this is the 4 hour supply region. And the reason why we will pick this, let me just hide this area. So this is the 4 hour supply region here. You can see this region. So essentially looking at how price tested as a support before it broke below. And this would be a region where price could come in and retest again as a resistance. So coming into this area, right? So when price enters into this region here, ideally, what we want to look for would be a decline in volume, right? So what we want to see is that while prices continue forming higher lows and higher highs coming into this region, we want to see a decline in volume, which can be in a form of lower lows. So in this case, this would show us a bearish divergence, but this could also indicate that there is a lack of buyers coming into the market. Buying pressure is not sustainable. And in this case, right, you can combine a few other indicators. It can be based on, the trigger can be based on moving average. It can be based on change in structure on smaller time frames, right? So on the 1 hour, right? So the details of how we can combine multiple time frame analysis and market structure, you can take a look at yesterday's session. So we do go into details with a few examples. I believe it's on dollar yen, right? And looking at how we can combine the structure on the 4 hours, 1 hour, as well as the 5 minutes. So in this case, you can see here, right? So when price comes into this region, what we want to see for as a confirmation would be a decline in volume. That's one. And if you have other trend following indicators that you're using, for example, moving average, then you can use that as a trigger as well. So maybe a break. So in general, if I use moving average, I use the 20 EMA, right? So you can just toggle between the different periods to see which is the one that would provide a clearer signal. So in this example, you can see here, right? So this is the EMA. So the difference between exponential moving average and moving average, it's that exponential moving average gives more weight to recent price, whereas for the moving average, it's equally weighted. So if you're taking 20 periods, it takes the values for the past 20 periods and it just divides them accordingly. So let's say on the EMA, right? So if I take 20 days EMA, you can see here, right? So right now, when price enters into this zone, right, you can use a break below the 20 EMA as a trigger to take shots. And this accompanied with a fall in volume could be confirmation that this supply area that we have on the higher time frame, this gray zone, it's going to hold to push price lower. Okay, so that's one way to use OBV, right? So another way you can use it, right, so would be to combine support resistance areas. So let me try and find an example on that. So take this example. Let's go on to a different chart. Let's stay on euro dollar. Okay, so on euro dollar here, let me just remove all these drawings. So again, on euro dollar, right? So one way which will be useful in using OBV is to first identify support resistance areas or supply demand zones. This is important, especially because we don't want to trade when prices are in the middle of nowhere, right? Ideally, we want it to come into a key area. For example, this region here. So you can see that there is a strong resistance. The price came in to test it again here. So we saw strong rejection of this zone multiple times. And then again, price coming in to test this area as demand. So in this zone itself, right, having identified this zone, the next thing we want to do is to wait for an entry into this area. So you can see these are the potential zones, right? And these are the areas where price entered here. So let's focus on this portion of the chart. So you can see that coming into this region, right? So the first time price entered in this area, so this is a resistance area, price held as a resistance before we saw a strong break above this area. And it's also represented that by this bullish candle and a close above, right? So price came in, tested this area again as a support. And you can see that coming into this region, there's still decline in volume, right? We have a decline in volume here. So prices are continuing and their volume is declining over here, right? So coming into this area, you can see that when price taps into this region once again, which corresponds to this low, right? Notice that the low of this area, so if I were to compare the low of this versus the low of this, so let me just remove all these markings and you can see this clearly. So compare the last low, right, to the next low that we have. And if you compare the low of the OBV, you can see that this is an example of a bullish divergence. What this shows is that while prices continue forming new lows, holding within this support region, you can see that OBV itself has actually formed a new higher low. So there is an increase in volume. And also more importantly, right, you can see that this is an example of a bullish divergence accompanied with support resistance areas. So when price enters into a demand area or a resistance turn support area in this case, right? So imagine people who are holding on to their short positions. When price breaks above and assuming that they're not stopped out of this trade, when price comes into this region, right, it would trigger them to close their positions, which then creates buy orders, right? So if you're selling and you have your stop loss, essentially these are buy orders. So when price comes into this region, you can see that this area, right, people might close out their positions. It could also induce or entice buyers to enter, right, given that this is a graphical level. So when there is a divergence in volume, right, in the form of how prices are actually seeing a pickup in volume, even though it continued to form new lower low, this could be used as a confirmation for movement to the upside. So if you don't want to just use volume, right, there are other ways you can use it. So for example, the moving average, right? So moving average itself is a trend following indicator. So ideally it should be used in a trending market. So in this case, you can see that this is not the best example for moving average because prices are moving sideways. So take a look at this example. You saw how prices chop around this range. This range here. So let me just remove the divergence and let's take a look at this example, right? So this is a ranging market. You can see clear movement sideways before a strong break above this area. So in this case, moving average itself might not be the best indicator because it will give you many false signals. You can see this example here, right? So when prices are moving sideways, moving average, because given its nature, it's a trend following indicator. Ideally, you want to use it in a trending market. So what we mean by this is that there is a clear, strong movement either upwards or downwards, and you see that this moving averages would usually act as dynamic support resistance or resistance levels. Okay, so this is one example. So with this example on euro dollar, you can see that while you have a ranging market, right, on and confirmation in terms of volume, so we saw the divergence in volume. You can see this again here, right? So this is a nearer divergence where prices form a new lower low, whereas there is a pickup in the OBV, right? You can see a clear higher low being formed. This is a bullish divergence. Oh, in this case, this is not, right, because the movement doesn't correspond to it. So it'll be like that. It'll be this movement here. Okay, so when you're in a ranging market, you can use oscillators. So for example, stochastics RSI to help you to determine the overbought and oversold regions. So take a look at stochastics, right? So the idea behind stochastics is that it measures momentum. So over here, right, when prices crosses above the 80 line, right? So this can be set by the user in terms of the parameters. Usually it'll be set at 20 and 80 or 70 and 30. So the idea is that when price cross above this region, it's considered overbought, right? So when there is when it enters the overbought region and exits the overbought region, usually this shows a decline in price. When price enters into this region, this is considered oversold. So when price exits the region, we could see more upside in prices. So in this example that we have here, you can see this region, right? So let me just set this at 80 and 20. So you can toggle between the parameters, right? If the range is wider, so if you're using, for example, 70 and 30, then you could be, it will give you more signals, but at the same time, right, with more signals, there'll be more noise. So let me just change this bands to 80 and 20 so that we are able to see roughly how it's like. So in this region, you can see that the first thing first, it's that euro dollar, it's on a resistance and support level or a demand area. We see a ranging market. So EMA in this case would not be the best use, right? And then at the same time, we have a divergence in the on-balance volume. It's showing a pickup in volume here with prices forming new higher lows, with on-balance volume forming new higher lows, whereas prices are forming new lower lows. So in this case, right, you can use an oscillator as confirmation, right? So once there is a new low that's being formed here, an oscillator as a confirmation would be a break and an exit of the overbought region, which is this area here. So when price enters into the oversold region, so the bottom's oversold, right? So when price enters into the oversold region and exits the region, it shows that there is basically, you can think of it as a lack of sellers entering into this market to push prices lower, right? So if you don't have any more sellers, when there is a lack of sellers, right, we could see more upside in prices. So the exit of this oversold region itself here, right, could be used as a confirmation in line with the on-balance OBV, on-balance volume, as well as graphical levels and prices. Okay, so this is one way you can combine OBV along with other indicators. But what I would suggest is that as with all these indicators, it's useful, especially when you're at a key level, instead of taking it just off any random levels, right? You want to ensure that prices are on a key zone. So this can be support resistance areas. There are a few ways you can identify them. It can be based on supply demand areas, or it can be based on just pure support resistance levels where you see multiple interactions. If you're unfamiliar with how you can identify support resistance levels in candlesticks, right, don't worry, just go on to the line chart. You can see that on the line chart. So let me just remove all these drawings and let's just focus on identifying this support resistance level. So in general, when you hop onto the line chart, just draw a horizontal line across, right? So ask yourself, where is this horizontal line that can segment the chart neatly? You can see here, right? If I were to put a horizontal line across, this area divides the chart neatly, right? So you don't have a case where prices are just whipsawing across this line. Rather, we are seeing a test of this area, right? And a respect of this zone. So if you're not familiar with using candlesticks, right, you can just draw them in line chart. The idea is to identify a zone instead of a specific level. So this is important because when we identify a zone, it gives us an area or region to work with. Okay, so I hope that this helps in determining how we can use the unbalanced volume as well as how we can combine them with in our analysis. So the other indicator would be the volume weighted average price. So VWAP is a measure of the average price. Essentially, it measures the average price of a security over a specified period of time. And this is based on the volume traded at each price. So in general, right, the VWAP line, it's the average price that's being traded, right? So in the FX market, VWAP can be used to identify key levels of support and resistance and to access the strength and weakness of a trend. So back onto our charts, you can see that you can find a VWAP line here. So I'm on TradingView, right? So you can just search indicators and type VWAP. So this should appear. So VWAP line itself, you can see that in this example, it consists of an upper band, a lower band, as well as the average price. So if you want to, you can actually remove the upper and lower band. So upper and lower band will give you a zone to work with instead of just dealing with the specific line, because in this case, you can see that it helps to deal with cases where price breaks below this region before it continued to the upside, right? So essentially false signals. So in this case, right, if we were to ignore just the upper and lower band for this example, right? So this is the VWAP line. Let me just remove this. Okay, so in general, on the VWAP line, right, when price crosses above it, right, it's the same concept as moving average. When price crosses above it, it gives us a bullish signal. When it's below it, right, it's a bearish signal. One thing that's interesting is that the price itself can act as a dynamic support and resistance level. So in this case, right, if I were to remove the moving average, you can see that over here, right, so this line that we're currently seeing, it's the average price over a specific time, right? So essentially when price comes into this region, you can see how it came and tested this region as a support. And then again over here, right, where price held as a support region before it continued to the upside. So VWAP itself can act as a dynamic support and resistance level. So if we have a clear market structure, right? So for example, if prices are sitting on a support level, same support region that we've identified earlier on, you can see this resistance then support level. So again, right, how we identified this is based on how price interacted with this region. You can see how price interacted with this zone multiple times. So the trigger, instead of, if you choose not to use the OBV, right, if you rather use the VWAP, one way would be to take a look at how price react, right, once it enters this demand area. So when price comes into this region, you can see that testing this region itself, right, when price comes into this area, when there is a break above the VWAP line, so in this case, this region here, you can see that when there is a break of this area, this could trigger a buy entry with a stop loss just slightly below this zone. So that's one way to do it, right? If you want to wait for more confirmation, another way to consider would be to wait for price to test a specific line. So in this example, you can see that prices range around for quite some time. We're looking at around from 19 December, 22 December, so it's about 3 days, right? So price range around this zone for 3 days. And on the break of this area, the break of this region, you can see that this VWAP line itself held nicely as a support. So when price breaks above this zone here, or rather when price tested this support area, right, you can see that price broke above the VWAP line and retested this region again as a support. Over here, you can see that. So this is important to note that we don't want to trade solely based on VWAP. It's still important to determine the market structure and order flow, because in these examples, you can see that this would give a lot of false signals, right? Induces a sell over here. If you're trading purely based on crossovers, right? When price cross below this area, you're taking it as a resistance and selling it. And again here. So this is just something to note, right? When you're trading with VWAP. So in general, right? While you can, one thing to note is that when prices, depending on how prices are trading, if it's within a range, you want to ensure that you're using, apart from just volume indicators, right? You want to combine them with oscillators for confirmation. If it's a trending market, then you can use trend following indicators like moving average to determine, to use them as triggers essentially to determine your entries. For volume itself, right, take a look at the divergence. So on balance volume, this example that we saw earlier, you can see how price move and diverge, right? So essentially when prices are forming a new lower lows and on balance volume is showing a pickup in volume, this could indicate that there is buying interest, and especially so when it's sitting on a key level. Okay, so this is an example of how we can use VWAP. So yep, so with that, we have come to the end of this session, right? So I'll just do a quick summary of what we've covered thus far. And if you guys have any questions, feel free to put them under the questions chat. So first, we covered the basics of volume analysis, right? So in general, volume can be useful to validate trend signals as well as confirmation, especially on breakout. So ideally, we want to see a breakout accompanied with higher volume. It can also be used to identify potential reversals, especially when price entered a key area, right? So potential reversals can come in the form of divergence, right? Where there's a pickup in price with declining volume. And the next one that we talked about, it's a relationship between volume and price. So in general, higher volume during a price trend would indicate strong buying pressure and selling pressure. And this would be in favor of the trend. So the trend is likely to continue when there is higher volume. Whereas if you have low volume, right, in this case, the trend could not be sustainable. Right? So there's a chance that we could see a reversal. We covered the advantages and disadvantages of volume analysis. In general, volume can give us valuable insights into market activity, especially in identifying reversals or providing confirmations on breakouts. But at the same time, right, especially in the FX market, because there's no centralized exchange, so volume itself it's limited, right? So it's limited specific to that a specific broker rather than just the aggregated volume. So we also covered commonly used indicators, right? On balance volume and VWAP. And on balance volume itself, you can see that they can be useful in identifying divergence. So this could help in determining reversals. Whereas for VWAP itself, right, it's an average price, right? So VWAP can be useful to act as a support or resistance level, right? So this is a summary of the volume analysis, right? So for tomorrow, we will be covering on the FX market outlook, as well as doing a review of any setups, right, that were made. Oh no setups were made on Wednesday, right? So yesterday we had our price action trading masterclass, right? So and for tomorrow's example, it'll be on the FX outlook instead of doing a review of the setups, right? Given that this week we are not doing any setups. Okay, so if you guys want to take a look at the schedule and sign up for the session, do go to vantagemarkets.com/webinars. You will be able to sign up for the session as well as take a look at the learning outcomes of each session. Okay, so I see that we have no questions. Okay, so if there are no questions, then that's it for today's session, right? So thanks everyone. Stay safe, trade safe, and we will catch you guys again tomorrow.